Hey everyone, welcome back to Corporate Decoder. Today, R.A.N.G Capital Acquisition Corp just filed an 8K, and I am seeing a small but important detail about their funding. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is drawing down more money from a loan, and it tells us a bit about their timeline and financial cushion as they look for a business combination. Alright, let's dive into this filing from R.A.N.G Capital Acquisition Corp. You might know them by their ticker symbols R.A.N.G.U or R.A.N.G.R on the Nasdaq. This is a current report, essentially an update on what is happening with the company. The date of this report is the 23rd of July 2026. This is important because it tells us what information is being disclosed at this specific point in time. The company R.A.N.G Capital Acquisition Corp is what we call a Special Purpose Acquisition Company, or SPAC. These companies are formed to raise money from investors through an initial public offering to buy an existing private company, essentially taking that private company public without the usual lengthy process. Let's look at what securities are registered. They have units, which are made up of ordinary shares and a right to acquire more shares. They also have the ordinary shares themselves, and then these rights. All of these are traded on the Nasdaq Stock Market, LLC. It is worth noting that R.A.N.G Capital Acquisition Corp is an emerging growth company. This means they are eligible for certain regulatory and reporting accommodations which can help smaller companies navigate the public markets more easily. They have also elected not to use the extended transition period for new or revised financial accounting standards, meaning they are adopting new rules as they come out, which is generally a good sign for transparency. Now we get to the main part of this filing, which is under item 8.01. Other events, this is where they report significant events that aren't covered by other specific sections of the 8K form. This section details a financial arrangement. Back on the 18th of June 2026, the company R.A.N.G Capital Acquisition Corp took out a loan called a Promissory note for up to $540,000. This loan is from their sponsor, which is basically the founding group that helped set up the SPAC. The money from this loan is meant to be used for monthly contributions to the company's trust account. The trust account holds the money raised from the initial public offering, and it is typically used to fund the eventual business combination or to return to shareholders if no deal is made. This is a key detail. The loan does not charge any interest. That is great for the company because it means they don't have to pay extra money on top of the principal amount they borrow. The loan becomes due and payable when the company either successfully completes a business combination, meaning they acquire another company, or when the company is being wound down, which usually happens if they can't find a suitable business to acquire within a certain time frame. This is a crucial point regarding repayment. If the company doesn't find a business to buy, the loan will only be repaid from any money left over. That is not in the trust account. This means the trust account money is primarily reserved for shareholders, not for repaying the sponsor's loan if no deal happens. Like most loans, this note has standard clauses about what constitutes a default. If certain bad things happen, the entire outstanding balance of the loan, including any fees or other amounts owed, becomes immediately due. Here is the specific event being reported today. On the 23rd of July 2026, the company drew down another $60,000 from this loan from its sponsor. This money was then put into the trust account. This brings the total amount currently outstanding on this loan to $120,000. Remember, the total loan can be up to $540,000, so as of this filing date, they've used about 22% of the available loan amount. This last sentence just explains the legal basis for issuing this loan. They are using an exemption from registration because it is a private transaction between the company and its sponsor, not a public offering of debt. Now we move to item 9.01, financial statements and exhibits. This section lists any accompanying exhibits. In this case, the only exhibit listed is exhibit number 104, which is the cover page interactive file. Essentially, this is just the machine-readable version of the cover page for this filing, important for data processing, but not something that provides new operational or financial insights for us. Now, looking at this filing, the big takeaway is the continued funding from the sponsor. The fact that they are drawing down from this interest. Free promissory notes suggest they are in a phase where they are using capital to support operations and their search for a business combination. The amount outstanding, $120,000 out of a possible $540,000, isn't massive, but it indicates ongoing activity and reliance on sponsor support. For context, companies like R.A.N.G Capital Acquisition Corp usually have a deadline, typically 18 to 24 months, to find and complete an acquisition. If they don't, the money in the trust account is usually returned to shareholders. This loan from the sponsor provides a bit of financial flexibility and shows the sponsor's commitment to keeping the SPAC operational during its search period. The current price for R.A.N.G.R, the ordinary shares, is around $0.26. and it has been trading in a very tight range between $0.25 and $0.26 over the past 52 weeks. This low price indicates that the market is not placing a high valuation on the company, likely reflecting the uncertainty inherent in SPACs finding a successful merger target. The REITs RANGR are trading around $0.29. This low valuation suggests there is a significant risk of the SPAC not completing a deal and the capital being returned. We see institutional holders like Magnetar Financial LLC and Harridan Circle Investments holding shares. But importantly, their percentage ownership is listed as 0.0%. This means that while they might hold some shares, their stake is so small relative to the total number of shares outstanding that it rounds down to 0%. This isn't uncommon for many SPACs, especially those trading at very low prices where individual holdings might be proportionally small. The fact that they are drawing down funds means they are actively doing something, likely covering operational costs or funding efforts related to finding a merger target. The interest-free nature of the loan is a definite positive as it minimizes immediate financial pressure. However, the ultimate success hinges on consummating a business combination. If they fail, the sponsor loan gets repaid from funds outside the trust account, which could be limited. The biggest concern for any SPAC investor is the deadline and the ability to find a high-quality merger target. These loans are a mechanism to bridge the gap, but they don't guarantee a successful outcome. The current low trading price for the shares and REITs reflects this market skepticism. That is my take. Stay decoded. If you found this breakdown helpful, please like this video and subscribe for more. The tools that help me analyze these filings are linked in the description.